Good afternoon, ladies and gentlemen, and welcome to Vincent's webinar series. Today, I'm Damien Davis, and I'm here to take you through financial distress and the sinking ship. It's a presentation in relation to insolvency. I am a senior manager in Vincent's insolvency department. I've been working in insolvency for approximately 20 years, both here and overseas, in the UK, the US, and the Middle East. I'm a qualified CPA and also have completed the Insolvency Trustee Service training. If you have any questions in relation to today's presentation, by all means, please feel free to send those through. I'm keeping an eye on all the questions and will be more than happy to answer them. And if I can't answer them during the course of today's presentation, I will ensure to get back to you privately in relation to them. So without further ado, moving on to today's presentation, being financial distress and the sinking ship. Let me just make sure that we're on the right one. There we go. So the agenda today is in relation to what is insolvency, the indicators of danger, when to look at ringing the warning bell for your clients, and then having a look at further questions. So insolvency. In Australia, insolvency is defined quite simply within the Bankruptcy Act and the Corporations Act as a person who is not solvent. So not exactly the best definition, but it basically is that a person will be considered not solvent if they are unable to pay their debts as and when they fall due. There are two common elements to the idea of insolvency within Australia. The first being cash flow insolvency, which is the major test that we have, and the second being balance sheet insolvency. The difference being the cash flow looks at the circumstances of the funds available to the parties, including what sources extra funds may come from, plus also looking at the timing of debts that need to be addressed and looked at. The balance sheet idea of insolvency is more purely just simply a look at what assets and what liabilities a party would have on its balance sheets. So, as we say, with respect to cash flow, solvency being the primary indicator, it's more than a difference between sort of just saying, hey, look, I've got more liabilities. And it also isn't necessarily a temporary lack of liquidity, which, we all do have personally in our own lives. I've certainly got it every time the mortgage has to come out, and businesses are no different. A temporary lack of liquidity, use of an overdraft, all those sorts of things. That's not necessarily a position of insolvency. It only becomes an issue of insolvency as and when it becomes endemic, and that's when it is. The quote that's associated with that is always that a lack of liquidity is effectively an embarrassment, and the other one is more a systemic issue and needs to be addressed, and obviously deals with the fact that the company is not financially viable moving forward. As we sort of say, having assets isn't necessarily a sign that a company's necessarily solvent. On the same note, just on the basis that effectively, you may not be able to realise those assets. Things like goodwill, for instance, on balance sheets, etc., are certainly no defenders towards whether a company is insolvent or solvent. Goodwill was very, very difficult to convert to cash, or any other realisable type of asset. By the same token, you may have property that is also very difficult to convert to cash, or at least take some time to do so. So the fact that you do have the property and it's worth, in your opinion, X, Y, Z, doesn't necessarily mean that you're not insolvent, because you may have debts that need to be paid before you would have any reasonable chance of realising that particular property. So with respect to that, ASIC and various other bodies have given us some ideas of what they would consider to be indicators of insolvency. In particular, ASIC did it in relation to a court case called Plymouth, which now goes back quite a few years, and they came up with a checklist, effectively, of looking at how an issue of insolvency would be addressed, and these issues were effectively taken on board by the courts, and generally form the framework of what insolvency considerations are brought into place by liquidators these days. So the first being financial statements and financial statement indicators, continuing losses and liquidity ratios below 1. So effectively looking at your current assets and your current liabilities, i.e. those things that need to be converted to cash quite quickly. And if you have a liquidity ratio where your liabilities are significantly more than your current assets on an ongoing basis, then that is a strong indicator of insolvency. Again, we would highlight that financial statement isn't the be-all and end-all, and it's certainly something that needs to be looked at in conjunction with quite a few other issues. Cash flow indicators, as we say, are by and large the largest methodology that we use in order to determine insolvency. And we're looking at things like the inability to raise further capital, unable to get other finance, issuing of post-dated checks, payments to creditors in round sums, paying creditors outside of standard trading terms, and overdue Commonwealth and state taxes. As an insolvency professional, overdue Commonwealth and state taxes are probably the primary indicator that we see. Usually the first thing that stops getting paid is that. Then you start looking at paying creditors outside of trading terms. Now, the issue of paying creditors outside of trading terms is something that is determined on an industry-by-industry basis, and also on a historical basis with the company in question. You may find that your largest supplier, who you've been dealing with for a long period of time, you've got a comfortable relationship, or your client has a comfortable relationship with that, and they're more than comfortable with paying, everybody else is on 30-day terms. Your client's paying on 60 or 90-day terms because they've been in business for ages and ages and ages. In those particular cases, we would be looking at 90 days as being the trading terms. It's something that has to be taken into account based on industry and the circumstances of the individual business. One thing that's quite interesting to note in relation to this, and we will address this in a future webinar early next year, most recently the Australian government has brought into effect what's known as a safe harbour regime, which deals with the circumstances of companies that are looking or fear that they may be looking at insolvency. And one of the issues is to give creditors, or more importantly to give directors, I guess, an opportunity to sort of realise that they're in difficulties, and to give them a window of opportunity to restructure a business or to turn around a business, prior to any formal insolvency appointment, be it a liquidation or an administration. With respect to that, the only time at which you're, as a company director, entitled to look at that or apply for those provisions is only when, for instance, your state and Commonwealth taxes are paid in full and your employee entitlements are also discharged. So they're probably two of the major components that we see, or the major indicators of insolvency. Things like super not being paid and outstanding PAYG, outstanding BAS returns, those sorts of things. The government has acknowledged that that's a regular thing, and so even under the new legislation, in order to apply for the safe harbour and to gain the defence that provides against insolvent trading, a director would have to have those lodgements are all up to date, submitted to the tax office, and not have any outstanding obligations to its employees. It's important to note that its taxes don't have to be up to date. It's just the payment of the PAYG and the super and those sorts of things. Outstanding other taxes are allowed to be behind and subject to restructuring arrangements or deals to be done. So we will provide a more detailed presentation on that particular issue early next year. It's a paper that I'm currently in the process of writing. The legislation is due to come in on a staggered basis over the course of the next 6 months or so, leading up till 30 June of next year. So getting back to financial distress, we've gone through the cash flow indicators. There is a third class, which is creditor relationships, which is all based on stuff that's not exactly something that you would find in the balance sheet or be able to ascertain from the financial accounts of the company, and looks at the relationship that the company may have with, say, its major suppliers or its major creditors, being in all likelihood a bank, its ability to borrow further funds, what arrangements it has with its creditors. Are there special relationships in place to allow the company to continue to trade or continue to receive goods, and also things like summons letters and other correspondence that the company would be receiving to indicate that it is in financial distress and it's outside of its terms with its various suppliers, and has considerable financial pressure or considerable written pressure to deal with its affairs. With respect to these indicators, there are some other ones that we do look at. What we've just been through were the major ones that were covered in Plymouth, and the major ones that are identified by ASIC and the other regulatory bodies. One thing that we would also look at is ongoing negative net assets and unrecoverable loans to related parties. These are matters that quite frequently come up, quite frequently things that we see on balance sheets of companies that we're liquidators of, and are fairly reasonable indicators of insolvency, particularly loans to related parties used to hide various issues. I provided 2 parties, and we're more than happy to provide these notes to people should they request them. Some of the ratios that we use in determining our analysis of insolvent trading. The most easy one, I guess, is the current ratio, which looks at the cash position of a business. It's also known as the cash ratio. As I say, it's basically current assets, debtors, stock, all the various things that are quite easy to convert to cash, and then converting that by the current liabilities, i.e. those liabilities that need to be repaid within a short period of time. It's not really obviously the most complicated ratio in the face of the planet. The higher the ratio, the better, obviously. And a ratio of 1 or more means that the current assets are more than the current liabilities, and there's likely no insolvency position going forward. The quick ratio is literally just a pure cash, I guess, figure. It takes out inventory and prepaid expenses. Again, it's more an immediate ratio, and then looks at those compared to current liabilities. It's more of a detailed step that you would take into account. Further ratios that may be of assistance: the debt service coverage ratio, which looks at operating income, over the debt payments and the lease payments. Again, these are obligations that need to go back to your various service providers, including banks and leased assets. A higher ratio is obviously better, and it represents the number of times that your operating income can be used to pay off principal and interest payments in respect of those various borrowing facilities you may have. When to ring the warning bell. So this is, I guess, more for external advisors in relation to companies that they are appointed over or their service. Look, my general advice in relation to this is, the sooner the better. I realise that that's a very, very difficult thing to do. And it's very often difficult to go and advise your clients that there is a problem with respect to their business and potentially that they may be looking at or indeed may be insolvent. Our position as an insolvency administrator is effectively the sooner the better that happens, because it actually gives us an opportunity to turn the business around and to look at various alternatives that might be available, such as administrations, deeds of company arrangement, and other alternatives, including potentially the safe harbour regime and a restructuring that might allow us to sit down and sort of come up with an alternative that doesn't involve the liquidation of the company. Look, the reality is that any of those alternatives is likely by definition to get creditors a better result than the liquidation of the company. Not only do they lose a client, it's also very likely that the sale of the assets and various other matters are going to be insufficient to ensure that they receive a significant dividend on the claims that they have outstanding. As I say, it's a difficult position, but our view is, at the very worst, you're bringing your client's attention to a underperforming section of their business and looking at alternatives on how to improve that particular performance aspect of their business and being able to go from there. As we say, the issue of leaving it too late is extremely common, and usually when that sort of comes about, the only real alternative is liquidation. You may have had deteriorations in relationship with your creditors, and it becomes quite difficult then to start to sit down and look at deeds of company arrangement and other alternatives, including safe harbour regimes and turnarounds, simply because you have such a poor, or potentially would have such a poor relationship with the creditors of the company, who are required to vote in respect of the various scenarios and to approve those scenarios, and work with you in order to have any chance of having the business successfully undergo a turnaround. Again, as with most things in life, people are much more happy to be in control of the process than what they are to have a liquidator or receiver turn up on their doorstep and sort of say, look, we're in control of this whole process. This is how it's going to go down. When you can drive the process, you can go and see an administrator, have some alternatives in place, develop a strategy. People feel there's a significant more amount of buy-in. There's a lot more chance of people sort of coming up with a solution that's going to be a little bit more beneficial for everybody. How you discuss it with clients is obviously something that's going to be dependent upon the relationship with the client. We generally recommend for people to focus on the specific aspect that may be brought to mind. The company, for instance, has a significant number of tax lodgements that are outstanding. Focusing on that issue, focusing on its ability to do its accounts, its ability to have an accurate position of its trading. That's one alternative. If it's a matter of the fact that it has bills outstanding for an extensive period of time, looking at what debtors that it has, what times it's got in relation to the collection of those debtors, and how that relates to its ability to monitor its short-term cash position is something that probably needs to be looked at. It's a matter of time of looking at the changes. These things will be something that will have changed over a period of time, 12 months to 18 months, and also having a look at applying the ratios that are included in this presentation to sort of show your clients exactly where these failings are going about. As I say, focusing on specific actual failings is or problems is a matter of sort of, we find it easier in relation to matters where we have to go and look at things such as doing pre-lending reviews for banks or lending reviews during the course of a loan period. You may find that it's one specific aspect of a business that is causing an issue. In certain cases that I've been involved in, directors have been involved in other areas of the business. Their focus has been somewhere else. A very common one that we find is that a business is expanding or it's looking to purchase a new business. Directors become focused upon that process, and then lose a bit of sight over the trading of the core part of their business, which has previously been doing quite well. And then you end up having to sort of sit down with them and sort of say, well, okay, your attention has been diverted. That's fine. That is what it is. But there is obviously a degree of suffering here. XYZ debt is an issue. Your largest debtor, for instance, may have gone into liquidation itself, and that's going to cause a major issue in terms of cash flow. Your major client, you're too heavily stocked in relation to one client. Any one of 1,000 different scenarios that can exist, which would cause that particular issue. But they're all things that can be worked out and pushed on, and certainly looked at. And as I say, with going and addressing those sorts of issues on a circumstance by circumstance business, you can get to a position and be able to sort of deal with that and be able to get a solution to that may be a much more simple solution in terms of a business, without having to become involved with insolvency practitioners or anything of that sort of nature. It appears that we may be having some degree of an issue with buffering. I understand our tech people that I can see behind me, or in front of me, behind the camera, are working on that particular issue. As we speak, we hope to get it finished or fixed. In the meantime, I will continue with the presentation as it exists. If there is any improvement in the buffering, feel free to let me know in chat. So moving on to these sorts of issues and how we should discuss these matters, or how we would recommend you discuss these measures. One of the things that we do find, particularly with external consultants, be they bookkeepers, accountants, solicitors, is sometimes a bit of a misunderstanding of the level of involvement that a practitioner can have, and having people come and see us and having us involved in the business. So, just in order to clear this up, and I'm sure it's well known to people, if you do consult an insolvency practitioner, we as insolvency practitioners are under no obligations at a consulting stage to advise anybody of a company's circumstances. We're not under any obligations to advise any regulatory body or any other third party that a company may be insolvent. There is an issue that if we were to sit down with your clients and sort of say, well, look, this business is insolvent, particularly if we were to put that in writing, if a subsequent insolvency administrator was appointed, they could, point to that as a position where the director was aware that they were insolvent, or also have been aware that they were insolvent, and that becomes an issue for insolvent trading. But outside of that, in terms of discussing the matter with your clients, going through the company's financials, all those sorts of things, even if we are of a position that the company is insolvent, we have no obligations to report to any party to sort of say, look, you need to look at this matter. Obviously, if there's a fraud or something along those lines, that becomes a little bit of a different situation. But as a stock standard, my business is not necessarily doing well. Certainly bringing in an insolvency practitioner and sort of discussing what the alternatives may be, what would be the different scenarios that could be looked at. As I say, there's no obligation on us to sort of go back to ASIC or any other party and sort of say, hey, look, this company is going to fail or is failing. In the majority of circumstances, certainly I know with Vincent's, we're more than happy to sit down and have an initial consultation and go through things and look at the company's circumstances, look at the company's balance sheet and sort of come up with some alternatives, be they insolvency alternatives or be they alternatives in terms of, this is how potentially it may be something that can be worked out and the business can be saved. There's, no obligation on our part to, and certainly no steps on our part in which we walk into a place and think, well, we're going to automatically liquidate this company. In fact, we prefer not to. As funny as what people think of us. But, our view would be that we're more than happy to sit down, for free and sort of sit down and sort of say, okay, these are the various scenarios that may be available to you in the circumstances. These are the issues that you need to watch out for, be they legal or be they accounting based. And if, the position is, as we say, with respect to a turnaround, is there something that's available there? Is there a safe harbour provision? More than happy to have those discussions, more than happy to have a longer term interest in those, and a longer term role in those. But, we would encourage people to, make the first step. It's not a matter of us being able to go to you. Although I know that some of our competitors, look at papers and look at winding up applications and make those sorts of judgments. Our view is that we would prefer people to come to us and to sit down and have those discussions. And as I say, confidential, look through the circumstances, come up with some alternatives that may be available. Some things that people may not have thought of, and take it through from there. As we say, the director is never under any obligation to listen to our advice or to anybody's advice. But, looking at the issue and getting it addressed quickly is, number one, it gives people more of an alternative to turn a business around. But, in particular, it also protects a director. I mean, at the end of the day, the only real exposure that a director would have in relation to those sorts of things is things like insolvent trading, preferences, director-related transactions, and the sooner that an insolvency administrator becomes involved, or somebody's able to sit down and have a look at a business and sort of say, hey, look, this is going to be a problem, or this potentially could be a problem, that's when a director is able to get some degree of protection and some degree of relief. The longer that process goes along, the more the directors are exposing themselves to insolvent trading actions. And to be frank with you, these days, that's a more likely source of recovery for liquidators. It's something that's been pressed upon us by the regulatory bodies, by the ATO, by the various other parties that are wanting to see us taking more steps in relation to these matters and prosecute directors in relation to those sorts of recovery proceeds. The sooner somebody sits down and is able to sort of look at these issues and say, okay, there is a problem here with the business, the sooner you can either get on a turnaround application or you can look at applying for the safe harbour provisions. and be able to move forward from there, knowing that effectively a director's personal position is also somewhat protected in those circumstances. This is just a very simple thing. Look, we know that effectively most accountants and most solicitors are certainly aware of these circumstances. When you do ring and you do sort of let your clients know that they are in a bit of an issue, but just as a reminder process, where these are issues that come up from time to time for us as insolvency practitioners. They end up resulting in us having to take steps potentially against an external advisor, and there's certainly things to keep in mind. The importance of keeping proper notes in relation to the writing off of loan accounts and revaluation of assets in these sorts of circumstances. Your level of involvement with a company, particularly in relation to circumstances where directors may ask you to sign checks or to approve payment plans to various creditors, or to even talk on their behalf with various creditors about the company's financial position. We'd certainly, caution you in relation to those steps, and ensure that effectively your notes are quite extensive on those particular issues, so that there's never a position that an insolvency administrator, be it us or anybody else, needs to come along and extend our investigations into those sorts of arrangements. It's not necessarily a pleasant experience for either us or for you as advisors. One of the other matters that's recently come up in a court case down in Victoria, actually, it was about 6 months ago, was the issue of willful blindness. In this particular set of circumstances, the external accountants for a business who were in charge of who were lodging the BAS returns effectively for the company, were aware that the company had undercalculated its PAYG obligations, and it continued to do so for quite a period of time. They continued to lodge the BASs and make the payments in accordance with their obligations. They didn't take any steps to advise the company to any great degree as to the fact that the company was undercalculating those PAYG obligations, nor did they advise the tax office of that. A liquidator was subsequently appointed, and the tax office funded them to take action against the accounts in question, and they were found, pursuant to the Victorian Supreme Court, as an accessory liability to the circumstances, in that they were aware that their client was under-reporting the position, and they took no steps to either advise their client or advise the party, being the ATO, of this particular issue, and they continue to lodge those BASs without any further regard. There is some question that the decision that was associated with this may eventually go to the High Court next year. I'm hoping sort of around about March or April of next year, depending on the development in respect to that, to be able to give a webinar to people, if it's so required, in relation to the issue of willful blindness and how that applies to yourselves as external advisors to various entities. So, plugging the holes. Again, this is a ratio, looking at various ratios in terms of their impact upon the trading business. What I'll do is we'll include these in the notes. I won't spend a great deal of time going through these individually. They are relatively detailed, and they're sort of set out here. I'm more than happy, should you wish to contact me, to provide a little bit more information in relation to these things on an ongoing basis. But for the moment, we will include these in the notes, and if you have any further questions, feel free to feel free to contact me in relation to them. Times interest, EBIT does all those sorts of fund returns in relation to the matter. So, formal solutions. This will be a very brief position in terms of what's available. I'm sure that the majority of people in this webinar are aware of the various insolvency availabilities that we have. Voluntary administrations, obviously being in place where a director will come and see an insolvency practitioner and seek to have an administrator appointed. An administrator will then investigate the business. We have approximately a month to assess the business and look at its viability. We then have to provide a report to creditors giving a recommendation as to whether a company should be liquidated or whether it should be saved, effectively through a deeded company arrangement. Any deed process would be up to a director or a creditor to come to us and say, well, these are the arrangements under which I would seek to revive the company or restructure the business. In general, a dividend would be paid to creditors on the basis of cents in the dollar. From that process, the general process that an administrator would look at is to say, if they go down a proposed deed route, is the return back to creditors more significant than what it would be if the company was liquidated? And in the event that that criteria is met, we would generally recommend a deeded company arrangement. Creditors then have a meeting and vote in relation to whether they would accept the deed on the basis of a majority process. The process is designed underneath the law to last about 30 days, but there are various other provisions that allow for extensions of time. In general, the court will look at an extension for the administrators of around about 90 days. If it goes outside of that, there would have to be extraordinary circumstances to facilitate that, but it's certainly something that is possible depending on those circumstances. So that's a voluntary administration process very, very simply. We can trade on the business during the course of that process, and we can use it to address other problems within the business, such as unprofitable contracts, leases, and employees. If certain sections of the company need to be laid off, or the company needs to get out of various leases, this is the process, or the formal process anyway, under which to restructure that business. Deeds of company arrangement, as we've discussed, they're a provision that allow the company to be turned around. In general, under a deed, the control and stewardship of the company would go back to the company's directors. There would be an obligation to make various payments. The source of those payments can be from any number of different sources, be it additional financing, be it payments from outside third parties, be it payments from the directors themselves. Those deeds, as I say, it's essentially a position of a voluntary administrator and creditors being convinced that they would be able to get a better return underneath that arrangement as opposed to a liquidation of the company. Where a deed is approved, all the creditors, whether or not they voted against it or not, would be bound by the terms of that deed. Creditors' voluntary liquidation, very simple. Effectively, the business is wound down. The liquidator is appointed. He investigates the aspects of the business, prosecutes any insolvent trading or uncommercial transactions, realizes the assets of the business, and it's sells property, cars, etc., deals with the secured creditors, provides a report to ASIC in relation to the circumstances of the business, and then hopefully issues a dividend to creditors. Obviously, then there's the other side of things, what used to be known as the official liquidation side of things, where a creditor would apply to the court to have a business wound up. Finally, again, this is just a more general thing. One thing that we find too when we get appointed as liquidators is obviously involvement with external advisors, solicitors and accountants, getting books and records, bookkeepers, whoever they may need to be. Essentially, this is our level of involvement in terms of what access to those records that we can get. The long and short of it is essentially that we're entitled to recover all the records of the company. We will invariably write to external advisors to seek those records and get copies of the files that are held. One thing that we sometimes find is that external advisors come back to us and say, well, are you entitled to these? Are you allowed to give? Do I have to give these up? What we will do is provide a listing of the books and records that we're interested in and a written demand. And we can get those issues provided formally through the courts or through ourselves. Usually we'll issue the correspondence the first time, and if it's not complied with, we'll then go and seek some assistance from the courts. In terms of the provision of information, one question is whether it's an external advisor is obligated to provide that information. The general sort of basis is that information that would have been providable to the client is providable to the liquidator. We effectively step into the shoes of the client, and so if the client was entitled to various bits of paper or details of various advice that was provided to it, then all that information is available to us. So if you've discussed it previously with the client, be it advice in relation to insolvency or anything else like that, that is information that the liquidator is certainly entitled to. In certain cases, external advisors, even after the appointment, may continue to assist their clients, such as providing a report as to affairs. One of the things that's not necessarily well known is that external advisors who do provide or assistance in preparing a report as to affairs for directors, they're entitled to be reimbursed by the liquidator for the costs of that under Section 475(8) of the Corporations Act. I'd encourage anybody who's in that circumstance to certainly talk to the liquidator and sort of say, hey, look, my reasonable costs and expenses are going to be this, and discuss with the liquidator having those costs reimbursed. Unfortunately, in relation to bankruptcy matters, there is no reimbursement provisions. A general listing of things that a liquidator is going to be looking at from you in respect of your clients: financial statements, loans, write-off of assets, liabilities, business valuations, advice provided in relation to the solvency or insolvency, and correspondence with third parties, including banks and other major creditors. As I say, 99% of the time we'll only be looking at what happened and why. Public examinations, we're entitled to examine not only your directors but yourselves in relation to these particular matters, and effectively in these circumstances, save for a few matters, we will be entitled to ask any questions, and you will need to answer those questions under oath and not be in a position to deny providing those answers. And then, of course, formally providing a proof of debt, which is a very simple process. If you're ever in a circumstance where you have to lodge a proof of debt in relation to a client and you don't understand how it is, by all means, feel free to give us a call. We'll be more than happy to assist you, but it's a fairly basic sort of thing. You'll need to provide details of your accounts with the client. If there's any oral contract or whatever, you'll need to provide a stat declaration in relation to the terms of that oral arrangement. feel free to provide any questions, and we'll come back to you. As they sort of say, a recording of the webinar will be available on our YouTube channel, and we'll also have a look to any of these issues. Again, we apologise for any of the buffering issues that have gone on, and if there are any questions, feel free to contact us, and we'll be more than happy to provide those figures. We'll also be more than happy to provide a copy of the presentation notes and take those things through. I hope that this has been of some assistance to you all, and I hope you have a good day. Thank you very much.